Hi, everyone. I'm Matt Voda, CEO of OptiMine, and thanks for attending today's session. I'll be talking about the balance between shorter-term paid media and longer-term brand building investments, but through the lens of more economic outcomes and kind of hard dollar types of results like revenue, new customer acquisition, profitability, and so forth. So just maybe a slightly different kind of point of view as it relates to measurement. Just a quick word about OptiMine. We're a measurement solution. We work with brands such as Paramount and Amazon and others to measure media performance. And as a result of the work that we do with brands, we frequently are sharing a challenge with the brands we work with in this interplay or this mix of paid media, lower funnel media, and upper funnel investments. And in particular, just about the conflict that can arise within a budget when you pit those two parts of the funnel together in a budget and decisioning process. Frequently we'll see that this is viewed as more of a zero-sum game, and the knives come out of the drawer, and there's conflicting priorities, as you can imagine, when you've got media, on the performance side, lower funnel, shorter term impact, quote unquote, more measurable. And you've brought in upper funnel investments into the same model, looking at a shorter term kind of revenue outcome. And in many cases, there's a lot of fear on the part of the brand team to even bring that data in, because they know that it's going to be a relatively unfair comparison when you're looking at a 60-day kind of revenue outcome. TV is not going to look as good as search. And so the reticence is that we don't want it in the model necessarily, but from a data science perspective, we know it's a good thing to include all these investments in the model, because all media has an impact, not only on economic outcomes, but also in terms of its branding effects. But nonetheless, there's this tussle over budget that ensues. And I see a lot of nodding heads because I'm certain many of you deal with this on a daily basis. So I'll share just a few best practices that we've developed over the years in working with brands on this basis. And then I'll have a case study here that just talks about what can go wrong if you don't handle this properly. So OptiMine, we produce an annual index across all of our clients in terms of kind of relative strength or weakness of different channels and performance. And we also look at allocations, and you can see brand in terms of kind of overall investment, our upper funnel, about 42%. It's been relatively stable year over year. The funnel position is somewhat subjective. It's really how our brands define it, and how they've kind of tasked the media within their portfolio. But these are kind of typical assignments that the brands will make. But what happens under the covers, which you don't see in kind of the stable view, is that there's typically a lot of jockeying that happens, in particular, this trade of upper to lower investments. And so in particular, if you're a public company and you have the pressure of quarterly results, I would say there's a lot more jockeying that happens, a lot more attempts to shift into lower funnel to hit a quarter, kind of bad behavior that may kind of harm the brand over the long term. You probably could get to the Binet and Fields kind of optimal mix, depending on how you kind of divide up the mid funnel and what parts of that go up funnel and what parts go to the lower funnel. But it's, again, on surface, relatively stable, despite a lot of turmoil that happens under the covers. We've developed some best practices to guide brands through those moments of finance pressure. And obviously, a simple one is to wall off brand spend when we're bringing it into the model, and comparing and evaluating revenue performance across all the funnel positions. It works better when there's a dedicated amount allocated to upper funnel, and then you can use some of the shorter term measures around acquisition or revenue to optimize within that fixed commitment. So, for example, if a brand is dedicating $40 million to upper funnel, you can use the predictive model to optimize within that, because there's a lot of levers, deep within even TV, for example, that can give you a boost in short term, but while still protecting the overall investment because it's a better long-term decision. So that's a common way to kind of push back on some of the finance pressure that may be put on upper funnels to have this kind of two-step commitment plus optimization. Give the media the best chance to impact short term to satisfy some of the shorter term needs, but wall off that spend. So from there, then the questions kind of change into kind of long-term goals, and the less measurable part of this is the next challenge to kind of attack. Because as you shift to a longer term kind of question of the media and its impacts, it becomes more challenging. And but it's key, I think, as part of the kind of protection, if you will, in the investments to have as many different mechanisms to quantify those impacts and by quantifying hard dollar economic impacts. So the good news is that that's possible. There are some tried and true ways to do this. The first is to look at paid media's impacts on, including lower funnel spend and upper funnel, and their impacts on brand awareness, brand outcomes, brand KPIs. And to do this, the consideration of the challenge is really to get a more persistent brand tracking mechanism. Some brands will use YouGov because it has more granularity. It has a signal that kind of persists more frequently over time versus a more traditional kind of annual brand tracking or brand lift study, which in particular, if you're trying to pick up signals in the lower funnel, aren't really going to find much signal. So you need something a little more persistent to pick up those total effects. The second approach then is measuring longer term, kind of shifting the lens back out, maybe on an annual year-over-year basis to look at changes in brand value and their relationship with economic outcomes. So what is a 1% lift in unaided awareness worth in terms of actual revenue to the business? And the key consideration there is that the answer around the brand KPIs, it's not a very dynamic kind of variable signal. Doesn't shift very frequently unless you're Tesla. And then it's a special case. So you don't have to run these analyses as often. And there's you can pulse this less frequently and get a good bead on that type of movement. And then the last piece of the puzzle is a little more complicated, but in terms of looking at the cross-channel interplay across the funnel, it's important then to quantify for upper funnel media, is it giving a lift or an assist to lower funnel? The most common example is TV unpaid search. When we're running TV ads, are we actually making search perform better? And you can quantify that. But the key challenge here is that that's a very noisy, complicated ecosystem, if you will. If you're a brand running 30 different channels, that's a big cross product of Halo to quantify. But if you do it and add all these pieces up, you have a much better view of the economic value of brand and a better way to defend that part of the funnel and those investments. So we have a pretty interesting case study that I'll share about what happens when brands cut their advertising pretty significantly. And to set the stage, we have two clients that we've been doing measurement for several years who had a unique situation where they reduced ad spend quite substantially. And for various reasons that we won't get into here, but it's the kind of situation for econometricians that's super ideal. Hal Varian, the lead economist for Google, talks a lot about the fact that in order to really value media impacts appropriately, you have to turn off media. And that's an unusual situation because we believe that media works. Brands are really want to avoid that. But this gave us two really interesting data sets to work with. And one brand's a retailer. We talked to them about some of the impacts that might arise as a result of this. They reduced spend by 27%. Brand B in this case study is a financial services brand. They went more draconian with their cuts, cutting 65%. And it's important also to note in this particular case, we're controlling for non-marketing factors and things like, in particular for the financial services brand, economic conditions that changed during this period, but seasonality, competitive elements, and so forth. So that gives us a better shot at understanding the impacts that happen as a result of this that are tied to marketing versus other things that were happening in the market at the same time. All right, so big shock. Revenue went down, with this reduction of investment. There was a bit of a sugar high in terms of profitability spike, short term, as a result of some of the cost efficiency of media that you'd expect to see, but even that subsided over time. And on the new customer acquisition side, we saw an even larger drop off, and that's a more dangerous outcome than the revenue. If you're acquiring fewer customers, you now have dug a deeper hole in outlying quarters. And we'll see in a minute, it's harder to dig out of that hole. And it also means that in this particular case, there was a competitive implication. If you're no longer in market, you've dramatically reduced your presence in the market, automatically you conclude that your competitors are taking up that slack. And that again compounds the long-term kind of impact of this decision. And if we look at longer-term impacts, they're equally negative, even when the brands decided to reinvest and to increase their marketing spend again. So return on ad spend was about 50% lower, which meant that the media had to work a lot harder to recoup this branding impact or this branding loss. And again, that makes perfect sense. In 2 years out, you're still paying this penalty because you've now reduced your brand awareness as a result of the advertising reduction. Cost per acquisition, same story, went up by over 175%. And again, I point to the fact that this is a kind of twofold challenge. Your media has to work harder to overcome the brand awareness drop, but it's harder to reacquire customers because your competitors have moved in during this period to take up that slack. So I will put my Captain Obvious hat on. Media spend went down, results were negative. Big surprise. What I haven't told you is that we work to try to predict this outcome. And it's less about our prediction, but more about the fact that you can know some of these things in advance. And if you're modeling not only short-term effects, but also these longer-term brand effects, you can actually call the shot. In this particular case, we had, again, this perfect situation to know whether the shot was accurate or not. But these are kind of knowable things if you're doing scenario planning appropriately heading into these types of decisions. And again, it's kind of the key to defending the upper funnel. So kind of netted some of this out. These are media impacts that are not happening in a vacuum. You have to kind of attack this challenge in multiple dimensions, if you will. You pay a longer term price when you make these types of cuts. Even when you're focused on that short term, media is not a spigot that just kind of instantly on and off, impacts the business that quickly. So if you want to copy the case study, I've got a QR code here. And with that, I will stop and answer questions.
Thanks so much, Matt. Okay, does anybody have any questions? Yes. Okay, why don't we go here first, John?
Hi, thanks for the presentation. Curious if you could share a little bit more about the cycle time to purchasing those two blinded examples. I was curious based on the results if like one was a longer lead time to the product purchase or the other.
Yeah, in the retail case, it's a shorter lead time you'd expect. In financial services, it was a mix of credit cards, personal loans, mortgages, and they each had their own kind of signature. So we actually broke the models into kind of unique model setups for each individual product line because of that specific issue.
Thank you.
Yeah, so another question back here, Carl? Yeah.
I like the story of brands going dark, and I think it's, sort of important manipulation. But there was an article in the Journal of Advertising Research by the Ehrenberg Bass team that also sort of looked at a whole bunch of brands. The obvious criticism is what brands tend to cut ads. Typically, they're the ones that are in bad shape. So they're already diving to begin with. And so how do you address that concern? Because again, it's the right manipulation, it's the right story, but there's an important compound.
Yeah, I will. It's a great question. Sometimes we get wrapped around the axle with brands about what's the right contribution percentage for media, and they tend to want to try to optimize something when it's actually really a reflection of how strong the brand is. A very large Fortune 10 well-known brand is going to have a smaller kind of incremental contribution of media than a relatively unknown brand. And it's an interesting parallel. In this case, this retailer has been in business for probably 70 years, very well known within its niche of consumers, a very specific niche of consumers. But a niche that has a lot of economic sensitivity, which is kind of part of the calculation about what they did with their ad spend. The other brand is part of a much larger, very well-known bank, lower kind of brand awareness, which I think in many cases was why some of their results were even more negative, because media was having to work harder to overcome a relatively weak brand. But weaker brands that are kind of in financial difficulty probably gravitate towards these types of cuts because of their dire situation. And obviously they prefer not to, but they kind of go hand in hand.
So was either of those brands that you would consider to be in those situations that Carl was talking about? It didn't sound like it, but
no, they're both still around, and they've had to kind of battle back, and it was a lot harder as a result. But they didn't go away.
Okay, so another question. I'm sorry. Yeah. Okay.
Fantastic presentation. Could you elaborate the very last bullet point of your last slide? Prediction is possible. What kind of data are we looking for when we're trying to predict this?
Yeah. So, the easy part is the kind of the transaction data, the economic outcomes. The point about the brand tracker, in some cases, brands may not have as persistent a tracker required to do something like this. And I mentioned YouGov. We don't have a formal relationship with them, but it's an example where they have a much more persistent pulse, and it gives you more signal to work with in the model. And that's really important to answer the second piece of the question is, if I'm able to use media to drive brand lift, what is it worth? Does it help me economically or not? And so you need more persistent data on that front to get to that that answer.
Quick comment about YouGov. I'm actually familiar, but my experience with YouGov is it's descriptive. In other words, it reflects what happened after it happened. So I was just curious, how do what data do you use to predict it before it happens?
Well, the nice thing about something like YouGov is it goes back in time. So and it's kind of always on. If you're in the YouGov panel, it's been on for some
Brand
time.
index or?
Yeah. But there are other kind of similar things out there, but that's the benefit is that you don't have to suddenly go find a new way to measure brand when you've got something that kind of already exists back in time, and that's really great for a econometric approach.
Okay, yeah.
Yeah, I'm just curious about the declining ROAS chart that you showed, because I think normally, often you have diminishing returns in the econometric model, but that's obviously not what you were seeing here. Does that to do with the mix of media that was involved, or was there a sufficiency argument here?
We saw a ski jump, so we saw a very short increase in return on ad spend as the brand moved across the yield curve, which you'd expect to see. Yep, there's a ski jump right there. And then, so it starts to drop after the first year. And I think that's where you start to see the weakening brand position really put a lot of weight on the media, and it becomes less efficient. There wasn't, that I recall, I had to go back and check. There wasn't, other than a big reduction in spend, there wasn't a big shift in terms of kind of the quality of execution. But there may have been some of that under the covers. Maybe they shifted to some of that, but in general, it was such a big cut across the board. I think it was fairly uniform, but it's a good question.
Was this just one of the two brands you showed before?
That's an aggregate. Yeah.
So is the aggregate two?
Yeah.
Is there another question?
Yeah.
Just congratulations. It's a useful contribution. And a comment that it's pretty consistent with a very long history of research, both at the ARF and Ehrenberg Bass and other places. Going back in the case of the ARF to World War II to
So it's the Captain Obvious. It's
but what it also says is, I mean, the media mix was very different in the 1940s and 1950s than it is now. And we did this most recently with the pandemic in studying brands going dark in response to the pandemic. And it's a little different story each time, like with a different media mix. On average, I mean, some brands don't recover. The cellulose powders, the Pepsodents, they're just, they don't recover.
Yeah.
And those that do, it takes on average about 5 years to recover your share of category.
Yeah.
And so it's just a very consistent story, but I think it's one that's worth continuing to monitor and look at.
Yeah, we continue to do work here and we'll have to come back. But we'll continue to watch this and see what the recovery looks like.
We got time for one more. Does anybody has any other questions or comments? Okay. All right. Well, thanks very much, Matt.
Thank you.